Welcome back to The Explainer. Today, we're tackling a subject that, let's be honest, often feels totally intimidating, but it is incredibly powerful once you actually understand the mechanics. We're diving deep into options trading market basics. My goal for us today is to completely demystify options trading for you. We are going to strip away all that confusing Wall Street jargon and leave you with pure, actionable understanding. So if you've ever felt overwhelmed by the derivatives market, you're absolutely in the right place. Let's unlock this together.
So first things first, we have to ask the foundational question. What exactly is an options contract? Think about the regular stock market for a second. Buying shares outright is extremely capital intensive, right? I mean, if you want to control a meaningful amount of a high-price stock, you've got to tie up thousands, maybe tens of thousands of dollars. But what if there was a leveraged alternative? What if you could control those exact same shares for a fraction of the cost? Well, that is exactly the power that options bring to the table.
Honestly, if you strip away the flashing screens and the complex financial terminology, an option at its core is just a simple handshake. It's a contractual agreement between two parties, a buyer and a seller. One person is basically asking for a specific right in the market, and the other person is agreeing to take on an obligation to fulfill it. That's really it. It's just two people making a deal.
Now, to avoid totally overloading you with information, here's our game plan. First, we'll cover the contract itself. Second, calls, puts, and obligations. Third, decoding the options chain. Fourth, dissecting option pricing. And finally, we'll talk about why traders actually use these tools in the real world.
All right, Section 1, the options contract. Let's get our basic rules and vocabulary down.
Okay, 100. This is your unforgettable multiplier. One single contract controls exactly 100 shares. Think about the sheer power of that for a second. When you trade just one option, you are moving a 100-share block behind the scenes. It's never a one-to-one ratio. For standard American-style equity options, you've got to keep this number burned into your memory because it literally affects everything we're about to discuss.
Next up, we have the strike price. This is the predetermined, fixed price where the underlying asset can be bought or sold if the option is actually exercised. Let's anchor this to a real-world example, okay? Imagine the stock is currently trading at $188 a share. You might look at an option that has a strike price of $200. That $200, that's your line in the sand. It's the exact price you lock in for your future transaction, completely regardless of what the broader market is doing. But here's the catch. You don't have forever. Unlike buying shares that you can just buy and hold for decades, options are wasting assets. They're kind of like a gallon of milk. They expire. They have a specific expiration date after which the contract just ceases to exist. If you buy an option and it reaches that expiration date without hitting your target, it becomes entirely worthless. And yep, you lose your entire investment. You absolutely do not have unlimited time to hope for a recovery.
Finally, we've got the premium. This is just the per-share price that the buyer pays to the seller. Remember that magic number 100 we just talked about? Well, this is exactly where it matters most. Because options are quoted on a per-share basis, you have to deliberately multiply that premium by 100. So if you see a quote for $3.50, that's actually a $350 upfront cost for you to buy that single contract.
Moving right along to Section 2, calls, puts, and obligations. Let's talk about the roles of the traders. Basically, the market is divided into calls and puts. A call option gives you the right to buy the underlying stock at the strike price. You'd buy a call when you're strongly bullish, meaning you expect the underlying price is going to rise. On the flip side, a put option gives you the right to sell the underlying stock at the strike price. You buy a put when you are firmly bearish, meaning you're betting the underlying price is going to fall.
But hey, it isn't just about calls and puts. It's also about whether you're the one buying or selling. The buyer, or the holder, pays the premium and their risk is strictly limited to exactly that amount. In exchange, they get the right to execute the trade. But the seller, or the writer, they collect that premium up front, but they take on an obligation. If the buyer decides to exercise their right, the seller absolutely must fulfill the contract. And that means sellers face substantial, and sometimes, theoretically unlimited, risk.
Okay. On to Section 3, decoding the options chain. It's time to learn how to read the menu. When you pull up an options chain on your broker's app, you're going to see a massive string of letters and numbers. It looks like a secret code at first, right? But let's just break it down, block by block. Take the symbol SPY 151219C211. First, SPY is our underlying asset. Next, 15 is the expiration year, 2015 in this case. 12 is the expiration month of December.
and 19 is the specific day it expires. That C right there tells us it's a call option. If it were a put, it'd just be a P. And finally, 211 represents the strike price of $211. See, once you know the pattern, reading these symbols becomes second nature.
Now, on the trading board, you'll also notice a few critical columns. The bid is the highest price a buyer is currently willing to pay. The ask is the lowest price a seller will accept. The gap between those two numbers, that's your spread. And finally, you have open interest, which tells you how many active contracts currently exist at that strike price. Open interest is a huge metric, guys. Higher open interest means higher liquidity, which basically means there are plenty of buyers and sellers around, making it way easier for you to get in and out of your trade at a fair price without getting stuck. Section 4, Anatomy of Option Pricing. Let's calculate the cost.
To really understand pricing, you have to think about moneyness, which is essentially the option's current status. In the money, or ITM, means the option currently has real exercisable value. For a call, it's in the money if the stock price is higher than your strike price. For a put, it's in the money if the stock price is below your strike price. Out of the money, or OTM, means the exact opposite. The option currently holds absolutely zero real exercisable value. Now, out-of-the-money options are definitely cheaper, but they're purely speculative.
So when you look at the total price you pay, the premium, it's actually just a simple math equation. Premium equals intrinsic value plus extrinsic value. Intrinsic value is that hard mathematical benefit you'd get if you exercise the option right this second. It's the in-the-money portion we just talked about. Extrinsic value, though, that is the pure speculation portion of the price. It's driven by two main forces: how much time is left until expiration, and implied volatility, which is basically the market's expectation of future price swings.
It's fascinating how these elements interact behind the scenes. The current share price and exercise price funnel directly into the option's intrinsic value. Meanwhile, all these other factors, like time to expiry, market volatility, dividends, and even interest rates, they all flow into the time value or the extrinsic value. All of these distinct data points literally pour into complex mathematical models like the Black-Scholes model to spit out the theoretical option value you see quoted by your broker. So when you buy an option, you're paying for both the actual value today and the potential value tomorrow.
And that brings us to Section 5, Why Trade Options? We're talking leverage and protection.
So why do investors willingly take on the complexities of the derivatives market? Well, first and foremost, it's all about capital efficiency and leverage. If we look back at our earlier example, you could buy 100 shares of a $188 stock for a massive $18,800. Or, thanks to that 100 multiplier, you spend just $269 to control the exact same number of shares through a call option. Honestly, that is incredible capital efficiency. It drastically lowers your upfront outlay while allowing you to speculate on market direction or even act as an insurance policy to hedge and protect a portfolio you already own.
So, now that you've got the mechanics, you know the terminology, and you understand the sheer leverage involved, how are you going to apply this? Are you going to use your new foundational knowledge of options to speculate on massive market moves? Or are you going to use them as a shield to protect your hard-earned portfolio? The tools are totally in your hands now. Thank you so much for joining me for this explainer, and I'll catch you next time as we continue to break down the complex world of finance.